He's got his track shoes on. He'll run around with the microphone. So where we left off was Schedule 3. So Schedule 2 and Schedule 3 were the schedules to develop the direct costs for MTS and non-MTS services. Now, over lunch, did anybody come up with any additional questions on these initial schedules that we went through? Question in the back?
Well, thank you, Keith. Yes. You want me to drop? Question on the schedules for depreciation of buildings and improvements. Now, does that mean what it would really say in a accounting format? Are we actually supposed to assign a value to our buildings and depreciate them over 30 or 50 years or something to come up with a value on that?
That was just an example. All of these numbers are just made-up numbers for example
No, not so
purposes.
much the number. I'm looking at the title, because if I read the title and I read it literally, it tells me I got to come up with a depreciation schedule for a fire station, which none of us currently do, I don't think.
Are you GAAP or are you cash?
We're cash.
Yeah, then you couldn't claim depreciation expense if you don't reconcile
You could.
your financials. It has to time your financials. I mean, it won't, because
So-
it's under year probably, but the number.
Right.
So you don't have to put a number in there.
That's right.
Right? You don't have to. If you're on a cash basis, we had a couple of agencies yesterday that raised that point, that they were on a cash basis. So, and they don't depreciate assets. So if you purchase an ambulance, that in that particular year, your costs are going to go up. Because you're going to include the entire cost of that ambulance in that year, as opposed to depreciating it over time. But I would advise you that if you can claim additional costs by depreciating your capital assets, including buildings or fire stations, go ahead and do that calculation. But it may it may involve change in accounting for you. Scott, did you have some comments?
No, you answered it.
And we'll get into how that depreciation gets allocated between the MTS and non-MTS in the next schedule.
Another question right here.
Ken, if we floated a bond to replace or refurbish medical equipment ambulances, would that be able to go in the cost report too, or since it has a separate source of funding, it wouldn't be included in that cost report?
I do not believe debt service is allowable per federal regulations, because you're either going to deduct the cost of the capital in the year that you do the acquisition, or you're going to depreciate that asset over time. So you can't claim the cost or the depreciation and the debt service at the same time. You'd be double dipping on that in terms of a cost standpoint. Yeah, you can do one or the other. I don't believe you can claim the debt service, so I think you need to claim the cost in the year that you acquire it, or you need to depreciate it. I don't believe federal regulations allow you to claim the debt service as a cost.
You should still be able to take the interest portion of that, though, because that's not included in the depreciation.
There is a line on Schedule 4 for interest for property, plant, and equipment.
Right, yes. The interest expense on the debt. Any other questions? I'm just waiting for Scott to get back here. So. Greta, do you have anything to add? Interest? Yeah. Okay, so we'll move to Schedule 4. So Schedule 4 is where we look at shared cost, allocation of capital-related salaries and benefits, et cetera. It'd be helpful if I was actually on Schedule 4. Nah, no, you are. Okay, so again, this is where we allocate the shared cost between the direct cost centers. And here we just really have two. We have MTS and non-MTS. So really, this is where agencies, as Scott was saying, there could be, there's possibly 300 public providers in the state, and there could be 300 different cost reports that are perfectly acceptable. This is one of those areas where agencies can be very creative in how they come up with these methodologies to split costs between MTS and non-MTS activities. It just needs to be reasonable and estimated and reasonable. Thank you. So it really, any reasonable methodology, and an auditor is going to come and look at this and say, okay, how did you come up with this allocation method? So as long as you can come up with a reasonable methodology, I don't think they're going to second guess you, because you know more about this service than they do. So let's take the first item here, depreciation expense. Again, it's just an example. So this agency had depreciation expense to be apportioned of $125,000. And you can see over here, get this working, 47% to MTS, 53% to non-MTS. And so how do we get to that? If we drop down below, there's another box. Keep going down to the, there you go. So here we're allocating on square footage. So this is depreciation expense related to a building. So this agency has gone through and determined that 5,340 square feet relates to MTS activities. 6,000 square feet relate to non-MTS activities. This could be based on office space for EMS and non-EMS. It could be based on the apparatus bay, how much area is devoted to ambulances versus engines, but some methodology to come up to split these costs that's estimated and reasonable. Right?
Ken, I was going to say, point out that this is also their checks and balance, so if it comes up with something less than 100%, they can.
Right. So Scott's pointing out that, this allocation factor and percentage needs to add up to 100%, so we're accounting for 100% of the building. So that translates to the 47% and the 53%, and that's how we would allocate depreciation expense, or it's how you could possibly allocate equipment or interest on debt that was used to acquire or refurbish the building or fire stations. So for each type of activity, you would need to come up with some methodology to allocate those costs, some reasonable way to split those costs between MTS and non-MTS activities. We'll see another example down below. We look at salaries. Here's our highly paid chief. So he's got salaries and benefits of $1,032,000 to be allocated. And if we go down to the bottom, there's another methodology to allocate salaries and benefits for this operations chief. So here we have hours logged for MTS duty, hours logged for non-MTS duty. So 4,992, 1,248, 80-20 split on salaries and benefits. So that's how we allocate the salaries and benefits. Again, these are just simple, quick examples, but that's the type of thought process that needs to take place in allocating these costs. Yes, sir.
So I don't know if you can answer this or if Shauna or Anna are here, but as we look at this, so we're going to go through this cost allocation process. We're going to make these decisions. We're going to send that into the state. They're going to approve it. But there was a slide in Shauna's presentation that said that after the fact, at the year's end, they can come back in and decide that you didn't do it properly and you have been overpaid and you have to pay them back. And there was a subheader on the slide that said that you could be fined for fraudulent activity. I guess the question is, once they decide that they agree with your cost allocation process, in your experience, have you, because you've done this in other states, what are they doing relative to, do they live with this, or are they going to come back and rethink it? And if they've overpaid you, based on some of the allocation model, that they can come back to the agency. So how do we, this is one of those where you measure twice and cut once.
Great, excellent question. So, two parts to that. One is, I think what the state folks were referring to had to do with the actual costs, right? And not necessarily the methodology, because I don't believe the folks will be looking at the methodology that you're using. They're going to accept that methodology that you use. And maybe later on, a state auditor comes to audit your cost reports, and they will get into the methodology that's being used and is it reasonable. So I had an agency in California, for example, that always did a 50-50 split of their firefighter paramedics between EMS and fire suppression. And that's how they established their budgets, and that's how they accounted for things historically. When they started doing these cost reports, they used the same 50-50 split. And when they received an audit, several years later, auditors came to audit their cost reports. They said, well, what's your justification for the 50-50 split? And they said, well, that's what we always did. We've always done that. And they said, well, no, that doesn't work. So they went back and did this sort of analysis, and they had to resubmit their cost reports. They ended up, I think they ended up getting a little more back because it was more like this. They had more time on task for the EMS than they did for the fire suppression. So I think there's two parts. The state's going to be looking at, number one, are the numbers right? Do you have that total cost, that check figure with the total expense per the agency? Is that number right? And are all these costs right between your salaries and your benefits and your all your other costs? And then a separate issue is looking at this methodology on the shared cost and how you do your general and administrative costs.
So I just want to go back real quick on this. So remember, this is, like I said in the beginning, this is a certified public expenditure program, okay? So while the state will receive your cost reports and they'll make sure that it balances with the information on the cost report, you as the agency, the public agency, you're certifying this cost. So on the front page, you're acknowledging that this meets all of the federal regulations, this meets all your CFRs, this meets the super circulars, and you're going to be able to provide source documents for how you came across this information and how you applied it. Also remember that under federal programs where they're providing revenue, these are what are called interim settlements, okay? So the state is taking your certification and they're applying your reimbursement on an interim basis. When you get audited is when they will adjust to a final settlement. And so your program runs different than other states, where other states work on a lump sum, you're on an ongoing basis. But on the final settlement, just like Ken said, you can have a final settlement that says, you know what, we underpaid you, and we're going to pay you a lump sum of $10,000. But in that final settlement, they may come back and say, you know what, this cost wasn't accurate, this cost wasn't accurate, and you're going to have to repay that revenue. And so for the most part, I can tell you from experience, I have not seen scenarios where mistakes were made to the point where a provider took in $300,000 and they had to pay back $250,000. Because generally the principles are there, some of the calculations might be missed or something like that. So where I personally have seen repayment, it's not astronomical amount of money. But yes, you can get into scenarios where you would have to repay that. So just bear in mind, you're certifying these costs. You're saying these costs meet the federal guidelines, and I don't want to scare you, but you're signing, somebody is signing that you've acknowledged those CFRs on that front page. So you have to have some level of understanding of what you're applying. And yeah, in the final settlement, you can have a positive You can have a negative, and ideally, you want to come out net neutral, that you did it correctly and nobody owes anybody anything. Okay?
So I had a quick question. Going back to the cash basis folks that are in here, which I know there's some of, are we able to capture like the maintenance and improvements directly in a calendar year on a facility, rather, since we can't depreciate, for example, painting or a roof or?
Yes, those would be eligible expenditures in the year that they are incurred. So if you're on a cash basis, you could possibly see some pretty large fluctuations in your average transport costs.
Okay, thank you.
Yep.
Can you confirm that this is reportable on the CFA?
On what?
That this is reportable on the CFA, the reimbursements?
I'm familiar
The
with-
schedule of 16? Schedule 16 for whether or not it's subject to the single audit.
Oh. Does anybody know about single audit? Yes. Yes, the answer is yes. I haven't done a single audit report for a while. So just as a reminder, what we're trying to accomplish with these cost reports is coming up with a cost per transport. So we've created the buckets, right? The MTS bucket, the non-MTS bucket, the shared cost bucket. So if you think about your general ledger and all of your expenditure accounts, they're all going to go into one of these buckets, right? So it's going to go into direct MTS, direct non-MTS, shared cost, or the general and administrative costs. So this is the shared cost schedule, and this is so we're determining some reasonable methodology for allocating these costs, and there could be more than just one methodology used to allocate the costs. Okay, let's see any more questions on that, so we'll go to Schedule 5. Schedule 5 is the allocation of administration and general costs, or general and administrative costs, as we like to say in the finance world. So again, as Scott mentioned earlier, there are several ways to go about this. So one is to itemize your general and administrative costs here, and you can see the various line items that are on the schedule. Again, the yellow highlight is where you would put in the information for your agency. The other columns come from different schedules. And if we go down to the bottom of this schedule, you can see there's an allocation methodology here based on total MTF services and non-MTS services. So all these general and administrative costs would be allocated based on this ratio of MTS to total direct, or non-MTS to total direct. So in this case, the MTS services are receiving 64% of the general and administrative costs versus 36% for the non-MTS services. And you see those up in these columns up here. So all these numbers auto-populate. These come from the direct cost schedules 2 and 3, and it just calculates that percentage breakdown. So that's one methodology for the shared costs. You could use the, if you have an OMB approved indirect cost plan, you can use that indirect cost plan, and those amounts would be included, I believe, in the direct cost schedules on 2 and 3. Schedule 9 for the OMB. Okay. You can also use the indirect cost rate, and we may get into that, how that's calculated later if we have time. Or you can use the, I think I mentioned the de minimis rate of 10%, and those would be on the Schedule 9s. So if you choose to do this methodology, and you could go through and do each type and see which one is more beneficial to your agency. But this would be how these costs would be allocated on Schedule 5. No questions on Schedule 5. We'll go to Schedule 6, the cost reports. These are reclassification of expenses. Here's just a very simple example. If you recall, we were looking at the training costs, and we saw there was a $5,000 adjustment to the MTS training costs. In this particular case, about $5,000 of training costs that were allocated to MTS were actually misclassified. So we're moving those from the MTS cost center to the non-MTS cost center, and we do that through this reclassification. So we're increasing Schedule 3, which is the non-MTS. We're decreasing Schedule 2, which is the MTS, and those auto-populate to those other schedules to adjust those expenses. This is where you could do cross-staffing. Okay, so you would be allocating a portion of your suppression costs where you have a cross-staffing of ambulance and an engine, and you want to move a portion of those salaries and benefits from non-MTS, from fire suppression to MTS. You could do that on the schedule here. Again, coming up with some reasonable methodology for allocating the time between those two activities. Any questions on this schedule? Okay. Schedule 6, Scott? Or, I'm sorry, Schedule 7. Schedule 7 is where the schedule we use to make adjustments to the costs. If you recall back on Schedule 2 for MDS, we had this $25,000 adjustment for bad debt expense. Bad debt expense is not allowable under federal regulations, so we backed that out of Schedule 2. Other items that would be excluded for federal purposes would be costs associated with your board of directors or your city council. Those costs are not allowable to be charged against the federal programs. Capital expenditures, if you're claiming depreciation expense, you would back out your capital expenditures here as well. So again, you have all of your expenses from your general ledger, and if you include capital expenses there and you include depreciation at the end of the year when you make your audit adjustments, you'd have to back out your capital expenditures. And again, these are in yellow, so you would do the input here. These would auto-populate to those, in this case, auto-populate to Schedule 2. Move to Schedule 8. Schedule 8 is where we include the funding sources. We include revenues for the agency. This particular case, we have our Medicaid fee-for-service revenue broken out by quarter. So we total $123,000, and here it is broken out by each quarter. Move down to the next column, Scott. And we have our there we are. We have our Medicaid managed care revenue. So this will only be applicable, I believe, for the first year. So it's all these managed care are going to switch to fee-for-service, as we heard earlier, on January 1st. But here we would track the Medicare revenue. It's okay. Totaling $135,000. And the next below is all the rest of the revenue that the agency receives in order to cover all the costs that are presented in Schedule 1. So we should be showing at least funding sources here, revenue and other funding sources equivalent to the costs that were being shown on Schedule 1. So in this case, there was some property tax revenue and some grant revenue coming in. And totaling the $1,058,000 at the bottom. So any questions on revenues? I think it's pretty straightforward. Go to Schedule 9, Scott. Schedule 9 is, this is important. This is the settlement schedule. So again, you have to answer some questions on how you're allocating your administrative costs. But this is your cost of MTS services from your Schedule 2. So this is the direct cost of MTS services. In this case, the answer to this question is yes, we're using an indirect cost rate factor. That factor is 15.8%. So we've gone through an analysis to determine the ratio of indirect cost to direct cost, and it came out to be 15.8%. So we apply that 15.8% to the direct cost for MTS services, and it's $462,855. So we're adding this indirect cost to our direct cost to come up with our total cost of MTS transports, $3,392,317 in this example. We move down, and then we look at our actual number of transports for this agency. So we can see by quarter here, managed care transports, 575, dual eligibles, Medicare, Medicaid, 600, fee for service, 525, other transports, 800. The total number of transports is 2,500. So we divide the cost above, the direct and indirect costs of 3.392 million by 2,500 transports, and we get the average cost per transport, $1,357. So this is very similar to the analysis that Scott went through and the one that the folks from the state went through. Now this next section, if you want to go up just a little bit, Scott, you show the title. So this is the calculation of the Washington Medicaid final settlement. So you notice what we're looking at here is the fee-for-service transports. So we take the information from above, so we have our 525 fee-for-service transports. We multiply that 525 times that cost per transport, 1,357, and we get the by quarter, and then we total 712,000. And remember on Schedule 8, the one we just looked at, we had 123,375 of fee-for-service revenue. So that gets backed out of our cost of these fee-for-service transports, leaving us a net of 589,014. That's the figure we're certifying to on Schedule 1. If you recall, way back on Schedule 1, we certified 589,014 was the cost of our fee-for-service transports. The non-federal share reduction, that's your share, is 50%, leaving 50% of the amount for the federal participation amount. So that's the 50% that you would be getting reimbursed from the GEMT program. Does everybody follow that calculation? Keith's coming over to the microphone.
Just wondering on the FMAP, so I'm just pulling numbers out of the air just for easy math, but what if half of our district is the 50% and half of ours are the FMAP at 90%? We would still fill this out like this, but then would we possibly get more back, like at 70% or something? Okay.
Yes, yes, you would complete this cost report just the way it's laid out here, because you don't know who the newly eligible are. But the state will determine that. I'm seeing a nodding, yes? The state will determine that for you, so it could be, potentially be an increase. At one agency, if this amount came out to, I believe it was $63,000 or $64,000, and then we got notified from they were notified from the state that they were getting an additional $11,000 to $12,000 because of the newly eligible fee-for-service transports. So again, I just want to emphasize that these are the fee-for-service transports. So that's why the change that the state is making to move away from managed care to total to 100% fee-for-service transports is important to all you folks.
We can't I know this is obvious, but this came up yesterday, and I'm sure you guys all get this. But I want to make sure that you understand this number here, you're already getting and you continue to get. This number here, the 294, is not replacing or including this number. So your GEMT benefit is double what your current Medicaid benefit is. I had a question yesterday, they said, so we subtract out the state's funds. No, this number here is in addition to what you're already getting. That's the benefit of this program, is this number is, in this scenario, is double what you're currently getting. That's the benefit to the program. So I just want to make sure that we understand it's not replacing what you're already getting, it's in addition to. Yes.
I think I can probably hear me.
That's everybody else.
There
There you go.
Sorry. So this isn't directly related to this. It's kind of more of the billing side of this. And so most of us here have some kind of billing mechanism we've set up, some kind of fee schedule. Does this in any way impact your fee schedule? For example, if we determine that our cost is $2,000 per transport, and that's what we're going to be billing, as our, do we also need to bill that to our other private carriers? Does it need to be that $2,000? So that's one part of the question. And then the other part is there any requirement that we send people to collections before we send them to Medicare to try and receive the reimbursement?
Scott looks like he's ready to answer that, so.
I get this all the time. So the first thing is yes, you have to bill for the services in order to establish an uncompensated cost. So if you're one of those providers that is not billing for your services, you can't establish an uncompensated cost for something you're not billing for. So,
But does it have to be the same cost?
but under your billing structure, there's federal regulations out there. Supreme Court had a really good one. It's basically a cherry picking law. You can't go out and arbitrarily pick a billing rate based upon a demographic. So in other words, you can't pick a billing rate for Medicare beneficiaries and another billing rate for commercial insurance. So your billing rates need to remain consistent. As far as the cost of this and what you charge, remember that this is a cost and loss program. So it is not respective to what you charge for services. So what you charge for services versus what your cost is on the report are two very different things. However, I would counsel you to really think about what it is you're doing, because if you have a billing rate of $900 a transport, but you have a cost report that identifies a cost of service at $1,500, you might want to rethink your current fee schedule, because your fee schedule is not reflective of what your actual costs are, and most businesses don't go into business to lose money. Whether you're making money or not is not the issue, but the issue is that if you have to have this discussion, you have a very good cost report to tell your electeds or even your community, this is what it really costs to transport somebody to the hospital, this is what it costs to provide the service. And no, you don't have to send somebody to collections to utilize the program. This is more of a billing and collections issue. But under your federal regulations, think of it as bill one, bill all. But there's no requirement that requires you to collect from all. So it's very common to bill patients for services, but you don't have to collect on those. So if there's an out-of-pocket cost, you're more than welcome to waive those. If somebody has a hardship they can't afford to pay, you can absolutely waive those. So you have lots of latitude, but you can't cherry pick and set rates for different demographics or payer mix. Okay?
Thank you for that question. That's a little bit of what I wanted to touch on is a final note.
We got two more questions.
Oh, okay. We'll hold that final note.
Sorry. I was just going back to what you commented on just before Scott spoke, that the state is moving towards fee-for-service away from managed care, which
Correct.
the majority of ours currently, I think 80% of our Medicaid is managed care. And I don't know where I got this, and maybe I'm confused, but I thought the fee-for-service portion, we could only recoup the difference between I didn't think we could do all the overhead cost. Am I wrong? Will this cost report apply to both fee for service and if they do move towards that?
So I won't speak on behalf of the state, and they're welcome to answer. I'll pass them back. So as part, they're all standing, so if they want to answer. But here's, do you want to? So here's the bottom line. In order to bring this program forward in the most efficient way that we could, and I say we because I really had very little to do with this. I congratulate the state. They did a tremendous job. The original program was originally an IGT for managed care and a CP or an IGT for fee for service. They went an intergovernmental transfer. Then initially there was discussions on CPEs for fee for service side, IGTs for managed care. The feds presented a concept of if you want to carve managed care out and put everybody into fee for service, that's a really clean and efficient way to do this. When this legislation was passed, there was a caveat in there of a 20% fee that goes to the state on IGTs. Very common, happens all over. So the state actually had an opportunity to recoup 20% of the IGT for the state's benefit. Your state, and I'm not a resident, but I got to tell you, I'm impressed. Your state looked at the value of the program to you, the providers, and they went ahead and chose to carve managed care, emergency transport, out of managed care and put it into fee for service. So for this first year, you have to reconcile because you're currently in managed care. But in January of 2018, you will no longer have managed care emergency transport services in the state of Washington. It's all in fee for service. And the state had an opportunity to make money on this deal, but they recognize this benefits you. Huge, huge step on behalf of the state. It wasn't anything I did, wasn't anything that Keith did. It was Jean and her team that did it. And I got to tell you, it's huge. There's no other state that's taken that aggressive a step in making this happen. It's worth millions and millions. And yes, all of this is counted on your cost report. Indirect, it's 100% allocatable, just as we've laid it out. So really, the people in the back is who you need to thank for that. That is massive. I can't express enough.
Ken, we have one more question here right now.
My question is on the revenue side. As a city, we transfer some money from general fund to our medical services fund to cover the costs that we don't recuperate on ambulance, and then we also charge a household fee to utility users. And I know some entities actually tax, they're in a tax based to help balance that. How does that revenue feed in? Do we have to subtract that revenue?
Want to back up to Schedule 8, Scott? Schedule 8. So we'll take a look at, go back to Schedule 8. The top portion was the Medicaid fee-for-service and Medicaid managed revenue. All the other funding source, you can go back down to the bottom, to the other funding sources. So all the other funding sources come in down here at the bottom. So you're talking about discretionary spending from your general fund, whether it's property taxes, direct property tax levy for EMS, it could be sales tax revenue, or some other discretionary revenue source would come in to make up the difference between your Medicaid fee-for-service, Medicaid managed care revenue up on top, and your total expenses that you claim on Schedule 1. So now we can go back to the other schedule, Schedule 9, and back to that settlement. What I was going to point out here is all this work we've been doing was to come up with this number, right? The total cost for fee-for-service transports. All we're backing out is the fee-for-service revenue. Not any of the other revenues, not any of the property tax levies or any of the other discretionary revenue. So it's just the cost for the fee for service transports, the fee for service revenue to come up with this difference, of $589,014 is what we're certifying to as the cost for these transports. And then your contribution is 50%, and the federal match is 50%.
So the other thing to keep in mind, remember, this is a cost and uncompensated cost program, not necessarily a revenue program. So when you look at cities, in almost every city, revenue goes into the city's general fund. It's really not uncommon to find fire chiefs or agencies that have no idea how much they collect on ambulance fees, how much goes into the general fund. And in many cases, I see cost reports in the cities where the fire chiefs and the finance people from the department have never seen a GEMT cost report. They have no idea what goes into the GEMT cost report. They don't even know that the cost report exists because the finance office within the city manages all of this. The only thing they ask for is how many transports did you do and how much revenue was collected on the Medicaid side. So it's a cost versus loss, and that's what it's doing. So you don't necessarily have to back anything out. Now, if it's a federal grant, then you do have to back all federal awards. So getting into the weeds a little bit, so if you do a recruit academy, and in that recruit academy, half of that recruit academy was funded through a SAFER grant, then you have to back all of that out because that's a federal award. So you have to exclude things like that. If you go out and buy cardiac monitors and 2/3 of the cost of your cardiac monitors was through a grant, then you have to back out, you have to account for that on your cost report because it's revenue, but you have to back out all federal awards from your cost because you can't double dip, okay? So when you look at these line items, you remember that you have to account for all revenue, all costs, all expenditures, but you have to back out federal awards. When you're looking at these cost reports on a slightly different thing, you're going to see line items in there that have nothing to do with the fire service from the standpoint of you won't see a line item for fire stations, but you will see a line item for plants. And I actually had a person ask me what plants are they referring to. Well, plants are fixed buildings. Those are your operational facilities because hospitals are called plants. So you have to look at the different line items. But it's not uncommon to find cities, not so much districts because they're like their own little cities. It's not uncommon to find cities that participate in GEMT and the fire chief and even the finance person have no idea what a cost report looks like, what goes in there. They don't deal with the billing company. The cities handle that. And they're not even aware that they're collecting that revenue or that revenue is going in. It all goes into the general fund and it all gets expelled out of the general fund.
Okay, so one final note on this settlement schedule. On that first page, there were on the certification page, there were a lot of certifications that the fire chief or the other responsible party was signing off on, that the costs were valid, right? So that's this number here. So it's based on actual incurred costs, right? And it's only those allowable costs. So you certify that you're backing out those things that are non-allowable, like bad debt expense, contracts that are percentage-based contracts, certain overhead costs like board of directors, city council type costs. Those are not included in there. You're also certifying that this is an accurate revenue number, an actual revenue number. So those are the kind of things that you're certifying on that front that certification page, and that you're a valid public agency provider of these Medicaid services. So we can go to, if there's no further questions on the settlement schedule, go to the notes schedule. This notes page is all yellow because you're filling in this information. The first block here is identify any contracting arrangements that you've included in your cost report. In this case, on Schedule 2, we included billing services of $25,000. We note here it's flat rate. So we know that these are eligible costs to include on the cost report because it's on a flat rate type contract as opposed to a percentage-based billing contract. So this is where you'd put those kind of notes with respect to any contracts. So if you have a contract with an ambulance provider, you would list that here and make a notation on why that was included in the cost report, or why it was allowed to be included on the cost report. Go down to the next block, Scott. On the notes page. Okay, this is the statistical basis for allocation. We didn't put anything here, but if you recall back for the building, it was based on square footage, so you would list that here. The ops chief salary was based on time on task, so you would list that here, and the applicable dollar amounts. And then there's one final block here we go. If any schedules were left blank, please explain why. This is, I think, something that the state folks asked for earlier. In this case, we said Schedule 5 wasn't used because we used an indirect cost rate. It may be if you had if you're an EMS provider filling out the schedule, you would not have done a shared cost Schedule 4, so you would list that here. I think the state mentioned that earlier in their presentation. And so that's really it in terms of the cost reports. So, do you have any final questions? Yes.
Sorry. We have a consolidated fire department. So our fire department is consolidated 2 fire districts working together since 2008, but not formally merged. So we report separately to the state, etc. However, we act as one fire department. So when it comes to recognizing all of this, do we need to do it separately, or can we do it as a joint agency?
Yeah, if you want to.
No, I don't want to, but I will.
Go ahead.
So, great question. Couple of scenarios to think about that tap into this, that actually occur. So there's fire departments that I've worked with that, still funny to me, that actually have a single fire chief and a single command staff, but they're managing 3 completely separate departments. Then I also have, I have fire departments that they're consolidated from the standpoint that they share certain resources, but they're 2 completely different entities. So the real question comes, remember, this is a transport program. So the question really comes is, are they operating under the same NPI number, National Provider Identification Number? So if Department A is providing transport, but they're operating under Department B's NPI number, that's a pretty dicey deal, because you can't be operating under somebody else's NPI number and incur costs and bill for Medicare and Medicaid services. So that's the first red flag. If you're doing that, you need to really sit down and have a discussion. But if they're operating under their own NPI number, so my department, and interesting enough, your NPI numbers can carry over. So my department, when I left, we were the result of 17 different fire districts. I show 12 NPI numbers under my current fire department's name, but we only operate off of 1. So it depends if you're structurally working consolidated, or if you are consolidated but you're operating under 2 separate NPI numbers. It depends on whether or not you're actually legally consolidated, merged, or if you're just operating jointly. If you're operating jointly, you have to operate under your own NPI number. If you're truly legally consolidated or merged, then you should be rolled into 1 NPI number and everybody operating off of that NPI number. And then if you're one of those agencies that has 3 separate fire departments, but they're contracting with a single fire chief or management team, then each of those agencies has to go back, just like we said before, on shared services, and you got to figure out what percentage of time that management team or those personnel are giving to each one of those agencies, and then you'll have to break that out. And what's interesting, because there's one in Southern California, they have three agencies, one fire chief, one deputy chief, 4 stations total, so that's why they operate that way. So they actually, all of them transport, they're all independent, but on their overhead cost, in their notes, they actually have to account for that the fire chief is only spending 1/3 of their time providing services here, and that the other amount of time will be carried by the other departments. And they actually reference the other cities that are carrying that chief. And that way, if they come in and say, well, how can you have a chief that's only here 1/3 of the time? Well, it's because it's split between 3 different departments. So they actually make a reference on their cost report in the notes that this chief spends time here and here. They don't say how much time because it's up to those agencies to determine their allocation. So that goes back to 300 providers, you can have 300 different cost reports. I would suggest that if you find yourself going down a pathway of there's only one way to do this cost report, that's fine, but understand that there is no such thing as only one way to do the cost report. And if you go down a pathway because somebody else is going down that pathway, or that's how that person's prepared the cost report, it may not balance out when you get audited to how you actually function as an agency. So each cost report has to be indigenous to your agency so that when it's audited, you can go back and say, no, this is actually reflecting what we do. It's not reflecting how somebody said to prepare the cost report. Okay? Did that answer your question?
It did, thank you.
Question in the back, Keith?
Actually, I have a very easy question. The documents that were emailed were in PDF format. Where would we get this in Excel?
On the state website, I believe, we have the.
Let me mention something on that. I'm speaking on behalf of the state. It's the last day I'll be here, so I can run back home and they can't get me. Here's some advice I will get you or give you. There's some of you in the room that may choose to not participate in the program. It's voluntary, that's fine. I would encourage you to, as soon as you can, enroll into the GEMT program with the state of Washington and get yourself into that process as quickly as you can so that you have access to any and all the documents that you need. If you choose later as an organization to not participate in the program, that's fine. There's no harm, no foul for enrolling in the program. If, because your cost reports are going to be due in March for this first go round, if come the end of February, you're going to scramble and try and get this done, that's one less thing that you have to deal with. And from my perspective, if somebody were to contact me by email, I will tell you the state will answer your emails. But I would encourage you to enroll into that program. They're providing that as a benefit. So when you send that email, they recognize you as one of their providers and not somebody that's fishing for information from, I don't know, Illinois because they're interested in a program. So no harm, no foul. I would encourage you to go back home and get yourself enrolled into the program as soon as you can get enrolled, become part of GEMT, and whether or not you participate, that's a decision you can make later. But all of that information will be through the state's website, and that's really the source that you should be going to, is the state when you're trying to get your documents and getting your information. This program will change. So as the state makes adjustments in their programs, and as the feds make adjustments in their programs, these cost reports can go 2 or 3 years the way they are now, and then next year you can have a change in the program, or the instructions might change a little bit. So it's really important that to get the most up-to-date, accurate information, enroll with the state and become part of the program. And if you don't participate this year and you choose to do it next year, if you got cost reports this year and you haven't been a participant in the program, you might find yourself working off of old documents. So I encourage you, enroll into the program. It's the smartest, best thing that you guys can do.
Maybe get on the distribution list for information.
Oh, yeah. Thank you, Ken. Speaking on behalf of the state, unauthorized, but you'll also be on the distribution list. So as they reach out, you'll be part of that distribution list. If they don't have a contact for you, there's information that you may miss out on. So really, you need to tap in, and they're your source. They are the go-to people for all things official with the program.
Okay, any further questions on the cost reports? Yes, back here.
I was just going to ask if we had questions later
Call Scott.
on this. Do we reach out to the healthcare authority, or where would we go to
Cost,
for information? if we
questions
had
on the cost
questions?
reports?
Yes.
So the state, now I'm not speaking for them. I'm speaking from experience. So the state has to walk an extremely fine line. It's like the IRS. I would love the IRS to actually prepare my tax report, because then if it's screwed up, I'm going to point to them and say, you guys own it. So anything about the program, you need to contact the state. Always contact the state. However, the state may not be able to answer questions about how you should prepare your cost report. Or if you said, can I put this here, or is this the correct way to do this? Very, very touchy issue. Some questions they can answer, a lot of questions they can't, not because they don't know it, not because they don't want to know it, but because once they make a commitment to you on how to do something, then the state owns it. And so all things, I would go to the state first for your information. If it's a process of how you should fill out a cost report, how you should allocate a cost, whether or not the methodology that you want to use will be acceptable to the state or to an auditor. They may not be able to answer those questions for legal reasons, then by all means, you can reach out. I'd be happy to address those. But I'm telling you, your source is the state. But there's some things they just can't do. Even though I know they would like to, they can't. Great people.
So that ties into exactly what I was going to say, is that the state auditor, not the state healthcare, does provide guidance on whether it's a relevant basis for allocation and things like that. So you can always go into the client portal on the state auditor's website and say, I'm thinking of allocating this on basis of FTE or square footage or whatever. Just give them the detail, and they will give you confirmation on things like that, and then just keep that in your file.
Excellent advice.